Calvin Emmanuel is joining me now. We're looking at all that's driven the global markets this week, particularly oil prices, which are on the rise again. There was a rumor yesterday that there was an oil explosion at one of Saudi Arabia's oil pipelines. Well, the authorities came out immediately to dispel that rumor. But of course, we do know that there's still rising tensions between Iran and the West. Iran now wants in exchange for money for its crude oil, gold and copper, and of course is targeting two major countries who are the biggest consumers of gold and copper. That's India and China. Well, Kelvin is here to tell us more about that. Good morning, Kelvin. Thank you so much for being here. Now, it's quite funny, the tactics that what Iran is doing right now with all the sanctions imposed on Iran, the central bank and all of that from by the US and Europe. Which have imposed very strict sanctions on the country. Now, Iran is saying that, okay, in exchange for gold, you can come and buy our oil, just give us gold or copper. And of course, we know those countries that are heavy dealers or heavy consumers of gold and copper. Now, why has Iran taken this step?
Well, to me, when I first saw the news, I thought it was a very creative step by the Iranian government. The central bank governor in Iran announcing that the Iranian government has decided to accept gold, copper, wheat, agricultural commodities, especially from India and China, who refused lobbying from the West to sanction Iran and stop buying crude oil from Iran. And the caveat to that, though, is that a particular U.S. North Defense Authorization Act, INDAC, says that the U.S. can actually stop transfer of gold metals, because if you realize that about 80% of all gold bullions in the world are deposited in Western countries, the U.S., based on that treaty, can actually stop any transfer of gold. So most of the bullions that are owned by China and India are domiciled in the West. So the caveat to Iran saying that they are going to accept gold in exchange for their crude oil is that that treaty can prevent any transfer of bullion from the West to Iran.
So what are the implications for the market? Because we do know that this would definitely take the West, that's Europe and the US, back to the dialogue table, you know, in terms of strategy, what they can do, or the kind of next steps it will take in order to bring Iran or rein in Iran and its nuclear program, which is still insists, you know, for peaceful purposes.
The implications are, number one, on Monday, Benjamin Netanyahu, the Prime Minister of Israel, is in Washington to speak with President Obama, and I believe President Obama will want to temper his anger when Leon Panetta had said that there are indications that by the second quarter of this year, Israel might strike. Now, the U.S. believes that, the Pentagon believes that Israel does not have the military capacity to handle such strike, and the U.S. is not willing to support Israel in case they run out of stock. So it's a very dicey situation. I believe that this step by Iran and the impetus by the West is going to drive up the price of gold. We might see gold at $2,000 before the third quarter of this year. And that's
if China and India decide to actually purchase Iranian oil, using gold.
If China, because the US, the only tool the US has now to prevent China and India from paying gold and other commodities to Iran for crude oil is the North Defense Authorization Act, which prevents a treaty that prevents them from transferring bullion to Iran. Now, if they bring up that and China insists that, look, these commodities are commodities, we own these commodities, we have depository receipts to show that we own these commodities, we insist on paying India with these commodities, then the price of gold will go up. The implication of that is that Australian dollar will also go up, because Australia is the largest producer of gold in the world. The level of correlation between gold and the Australian dollar is about 97%. And when you consider the fact that Australia is the largest exporter of commodities to the Far East, you consider that the Australian economy will record lower GDP earnings, because a stronger Australian dollar is not good for competitiveness abroad. We also expect that if crude oil continues to go up, the Canadian dollar will go up, and it will hurt profits to the Canadian government.
Now, speaking about crude oil prices, of course, last week high oil prices spooked the markets. We saw Brent crude rising as high as $125 per barrel. It's come down. Of course, we heard that rumor yesterday from Saudi oil pipeline explosion and oil prices going as high as $110. Now, tying all of that down with the Nigerian situation, of course, there are renewed tensions here in the Niger Delta, in the creeks. Of course, like I mentioned earlier, it will be a major factor for the markets. Traders will definitely price that in. If there's going to be a supply disruption from Nigeria, one of the biggest suppliers to the US, that is certainly something the markets will be looking to price in. So going forward, we don't know how the situation will play out. We're hoping that, of course, complete peace will be restored in the Niger Delta, and all parties can work out their differences. But what is the implication for the markets going forward? Are we going to see crude oil continuing to rise?
Well, for Nigeria is on good footing right now. Somehow, the unrest in the Niger Delta is affecting the government's coffers positively, because the higher crude oil price goes up, even if there is a difference in the spreads that the OPEC charges as its benchmark price from the spot price of about $5 to $7. The higher crude oil price goes up, the higher the sovereign wealth fund records, because Nigeria has a benchmark price, and anything above the benchmark price goes to the sovereign wealth fund.
On the excess crude account.
As at the last count, the sovereign wealth fund had about $1.1 billion with the CBN domiciled in Nigeria. So we're going to see higher earnings there, and Nigeria is on track to meet up with its revenue estimates for its 2012-2013 fiscal year budget. But on the other side, why I have fears that the rally on crude oil will not be sustained is that in the past 4 years, since President Obama took office, the amount of production of crude oil in the United States, despite the spill by BP in the Gulf of Mexico in Louisiana, the amount of production has increased. The capacity utilization has increased from about 30% to about 83% today. So now the US government is saying, according to the Department of Energy, that as early as 2015, it expects that the US will be a net exporter of crude oil to the Far East. So you have a situation where now, before, the fear used to be that crude oil price goes up, and Saudi Arabia, who has a bilateral pact with the United States, comes out and guarantees extra supply from its reserve, and the market calms down, and the US tries to lobby and maintain the situation. Now, the West is not afraid. So Europe and US are bold enough to tell Iran that, no, you can go to hell with your crude oil.
Well, where does the boldness I know these countries, the US especially, and even Europe, have oil reserves. But going forward, of course, if they begin to tap into those reserves, they'll definitely come down. Maybe not significantly, but they will come down.
Yes, for Europe I can understand, but for the United States, the US has not had an issue of whether it has reserves that are limited or not. The US has had an issue of energy security, and the fact that most of its oil reserves are domiciled in very risky areas. Now, what the Department of Energy has been able to do in the last 3.5 years is that it's ensured it increases the level of safety requirements for oil companies who drill in very volatile regions in the US, like Alaska, close to Canada, and like the Gulf of Mexico, that is very controversial area, especially in the Senate and the Congress. Now, it's been able to increase the safety requirements for the companies. They are compliant to the safety requirements, and production has increased.
Okay, so going forward, should we see a correction in prices? Because right now, Brent crude is currently $126 per barrel. The light sweet crude is currently $110. Are we going to see a correction at some point, or some resistance level where prices will continue to come down? Or it will all depend on how the current issues, there's a tension in Iran and that here in Nigeria, how it all plays out?
Well, Esther, I believe so strongly that there is a variance between the real intrinsic price of crude oil right now and the current spot price. Let me tell you why. There's a variation of about $15 to $20, because that variation is caused by the tensions. It's speculative. It's driven by the markets, by the traders on the NYMEX and the LME. I believe that it will correct, because as crude oil price goes, the US government and the European governments, they have a particular threshold within which they will be forced to release desperate measures to curb the price. And it's really bad for Europe right now. So I believe that very soon they will come out with an announcement saying that they are either asking Saudi Arabia to release excess capacity, they are increasing production somewhere, or they are releasing a supply of crude oil from one of their reserves somewhere.
Okay, now different analysts came out last week saying that high oil prices will definitely impact on the economies of especially developed countries. Now, what is the main fear for developed economies as regards high oil prices? What is that direct impact or negative impact? What is the major concern?
The negative concern, especially for Europe, is energy security. Europe is in a very dicey situation. Its situation is a bit more dicey than the United States because it doesn't have as much reserves as the US has, and it doesn't have the kind of relationships, diplomatic relationships that the US have. So I think the major concern for Europe is energy security. The second concern for Europe is the fact that higher oil prices leads to higher expenses in purchasing crude oil.
Okay, I was going to come to that. Now, especially now that everybody in Europe, it's all about spending cuts right now, lower budget and all of that.
Absolutely, so. which affects them terribly. But on the other hand, if you consider the fact that a lot of European countries, especially in the Mediterranean and in Central Europe and Eastern Europe, have been more reliant these days on gas, natural gas, than they've been on crude oil, and they are moving towards a clean energy society. I think the fears are a bit suited and balanced, but Europe is in a more dicey situation right now.
Okay, let's leave the commodities market where it is right now. Let's go over to the equities markets. It's been a very good week for the Dow, and it seems like the Dow is just, the American markets are having all the fun in terms of equities rally this week. The Dow hit 13,000 points, I think that was on Tuesday, the first time since 2008. Even the S&P hasn't done too badly. So in terms of the other markets, it would seem that the American markets are just the ones making the major recovery.
Well, if you look at it, you see that the situation in Europe is beginning to become clearer as to what exactly is going to happen to Greece, especially, and to other troubled nations. Again, if you look at the manufacturing index, although it dropped by about 2.6% in the past month, from 54.1 to 52.6, that is because the optimism which was caused by retail sales and consumer spending during the holidays in November and December has kind of slowed down a little bit. When you also consider the fact that consumer spending is coming up again, the only downside to it,
that came out positive this week. Hit a 1-year high.
Yes, the only downside to that report is that President Obama has removed subsidy on crude oil in the US to oil companies, about $4 billion per annum, and gasoline prices has gone up to about $5 per gallon. So the fear is that consumers in the US are kind of weary and skeptical, and they are saving instead of spending. Now that will lead to a little bit contraction and might slow down the pace of the recovery we've been seeing in the past 18 months. But overall, when you also consider that unemployment claims has dropped, it dropped about 15,000 this past week and is at a 4-year low.
But that's just the weekly claim, because I know it's the monthly, the non-farm payrolls data that the markets usually, take more seriously than the weekly jobless reports.
Yes, but the unemployment claim is also an indication that things are getting better, because unemployment claims basically is an insurance that the government pays to people who are out of jobs in the United States.
But at his semi-annual report, I think that was 2 days ago, the Fed chief, Mr. Ben Bernanke, dampened sentiment, saying that, there's still little to cheer about, the jobs market is still weak. I'm quoting him now. And of course, he didn't give any indication about the further monetary stimulus to the economy. That, of course, was a disappointment for our investors. So we have these numbers on the one hand, and we have the Fed chief saying that, the numbers came out positive, but don't rejoice.
The Fed chief does not have the obligation to be optimistic at any time.
Something goes wrong.
Central bank governors usually have a reputation to be pessimistic. Let me put it that way. Maybe I'm going too far with that. But the Fed chief, no matter how good, even if unemployment comes to 4%, he will tell you that it can be better. It can come to 1%, it can come to 1.5. If inflation comes down, he can tell you that it can be better. So I just believe that the Fed chief does not want to excite the market, because his statements are closely watched. In fact, they used to say that the US has 3 arms of government: the legislature, the executive, and the judiciary. That the 4th arm of government in the United States is the Federal Reserve. When the next non-farm payroll report comes out, which I believe will come out either today or next week Friday, I expect that to show that the private ADP payrolls, private payroll data in the US increased. I also expect that it will show that the non-farm payrolls, which are a collection of the total number of people working in government offices in the United States, also increased. I expect the official unemployment rate to drop down from 8.30% to about 8.15% or 8.2%. And then when you also consider that GM is back, because Toyota slipped during the quake in Japan, GM is back as General Motors. Yes, as the #1 car manufacturing company in the world. And a string of good policies, foreign policies by the U.S. government in the past 3.5 years has led to very excellent trade representatives America has had, especially to the Far East, has led to an increase in exports. The United States is set to double its exports by 2015, and its exports is really coming up strong.
So on the economic front, generally the U.S. is on a good, like you said, a good footing. So why is it that every time the U.S. Fed, Mr. Ben Bernanke, comes out to talk before Congress, the market investors are always waiting for him to announce extra monetary stimulus for the economy?
I do not think that it will be totally appropriate for say they are waiting for him to announce extra monetary stimulus. I just believe that investors are also very skeptical and worried about the markets, and that the Fed chief is also very pessimistic about the outlook on the markets. He doesn't want to raise the bar too high and the country performance falls below standard, because that will lead to a major sell-off. So he wants to, as much as possible, keep the bar low and have the data surprise what the expectations are. That's his objective at every time, so that it doesn't lead to a sharp drop, because you know that a lot of time when companies are going to announce their quarterly results, when they have earnings that even leads to profit, and then the earnings disappoint analyst estimate, it comes below what consensus estimate is, the stock goes down. So I believe that is approach. He just wants to keep the bar low and have the data surprise above the expectations. Okay.
Now for the equities markets, you think this is going to be a very strong first quarter run for the markets, because it looks like Europe now seems to have a hang on its problems, bringing the debt crisis under control and preventing a likely contagion. So is this, are we going to look, should we be looking forward to a first quarter? We've entered March already, and end of first quarter, strong rally for the equities markets from Asia to Europe, and particularly Wall Street.
The reason why I have fears for companies in Europe and the GDP estimates are, number one, Greece is really trying. It's cut out about 3.5 billion euros in pension and health and cuts from civil servants, and the intensity of the rallies in Athens is getting stronger. Again, the European Monetary Union has promised that they are going to release 20 billion euros for them to meet up with, $20 billion for them to meet up with March 20th payments. On the other hand, I have fears. I was just talking with you about $3.5 billion in debt swaps that are most likely to be due to companies that bought credit default insurance on the fact that the Greece government will default on their debt. The credit committee is considering whether they should announce that they are due for payment. If they announce, the Greece government has to pay. If it doesn't pay, it will lead to a bullish and bearish run in the markets.
So sorry to butt in, is that separate from its next payment obligation, the one on the 20th of this month, the 14.5 billion euros?
It's totally separate. It's totally separate. This is an insurance, it's a report given by the International Swaps and Derivatives Association.
Why wasn't that mentioned before now, or in the course of while all the deliberations were going on about how Greece will get the money and Greece's next debt payment?
Because the parameters on which the credit committee will decide if they should trigger a cash-in on the credit insurance swaps are not being met yet. And there's a lot of lobbying and power play from the European Monetary Union of the 15 banks that constitute this credit committee, including the likes of JP Morgan, HSBC and Goldman Sachs. When you come to Western Europe, you come to Britain especially, one reason why I'm very pessimistic on especially the Euro Stock 600, which lists the top 600 banks across Europe, is because when you look at the capital adequacy ratio that Britain has decided to have for its banks, which is 20%, 100% increase, or 100 times what it was before in Europe, and 100 times of what the banks are being asked to put up in the US, it's very high. When you also look at the fact that we're talking about this about 1 or 2 weeks ago, when you also consider the fact that most British banks are not globalized in operations. It's only the likes of HSBC and Barclays that has operations in the Far East, in the Middle East and Africa. When you look at the fact that the likes of Royal Bank of Scotland, TSB, Santander and some other banks in Britain are only focused on Europe, I have grim expectations on what their performance will be like, and I have grim expectations on the FTSE 100 and Euro Stock 600.
Okay, well, still on Europe. Well, now we got an announcement this morning that the Euro European leaders have agreed to put money into the zone's bailout fund. That's about 500 billion euros. They're going to make the first 2 installments, I believe. And of course, perhaps this is on account of the fact that just a few days ago, the G20 told Europe that Europe needs to commit more money to helping itself out of its debt crisis before the G20, as it were, can help them out in terms of providing funds. Now, is this what are your thoughts on this recent move by the leaders? Are they finally getting their act together in terms of committing more cash, putting more cash on the table?
Well, Esther, I believe it's a good one. I think it's the right step this time around. It's quantitative easing for banks. The first time it was done, remember they had about $645 billion to 530 banks, and we had reports that some banks were holding cash in vaults. This second time is $530 billion.
So many of them took the monies to put it in the ECB's vaults. They didn't do anything with that money.
And the ECB told them that the parameters or the conditions under which we granted you this money was not to keep it in vault. It's for you to ease the squeeze in the liquidity market. Sorry, in the interbank market. They were forced to bring back the money from the vaults and start lending to debtors, as in companies who needed money to run their businesses. This second time is to 800 banks, and of course the conditions.
I thought it was 800 banks. I thought it was 80 banks. 500 billion euros.
Okay, maybe I have the wrong figure then. The conditions has been set again to them that they have to lend. They have to bridge that divide in the markets and reduce the borrowing spreads, European interbank borrowing spreads, which is typically an interest that the banks charge themselves to lend money between themselves. So I think it's a step in the right direction, absolutely, and I believe that it's positive for the European Union.
So can we finally take that much-needed breather and just relax over Europe and this debt crisis? Have they reached a point where they've made significant progress, where the markets can actually relax, so that whatever headlines come out from Europe concerning the debt crisis, it's not going to be one that will rattle the markets?
I think they are 50% done with solving the problem. The other
overall, not just Greece, and we know Greece is a major part of that.
Overall, they are 50% done, because the other 50% is now to look at how to grow the economy, how to get jobs back, how to pay attention to their debt to GDP, public debt, how to create new industries that can compete internationally. And, you know, it's very crucial and important that the governments start to rethink their competitive advantage. I believe that most European countries have lost their competitive advantage. They have to rethink it, and they have to find their competitive advantage. You have to find that area where they are strong, where they are unique, and where no other nation can do as good as they are.
Now, for Greece, quickly on Greece, I know it's very easy to get carried away talking about Greece, but quickly on Greece, now they've obviously made significant progress. All the legal requirements, for them in terms of paperwork to qualify for that bailout funds worth 130 billion euros. They've made that, but yeah, a few days ago, Parliament approved more cuts on pensions and wages and all of that. Going forward, how can Greece begin to focus now on growth and making their markets more competitive, as it were?
The only fear I have is that my Prime Minister Papadimos Lucas and Evangelos Venizelos are up for referendum and up for vote. I'm afraid that they will not survive it. I'm afraid they will not survive it, because they will be voted by the voters who are terribly angry right now.
But of course, for obvious reasons.
You have a situation where these people have experience in the monetary union. They've coordinated from Geopolitical, and they've been very successful so far in convincing the Hellenic Troika to cut expenses. The challenge for Greece is to privatize state-controlled companies, which makes the Greek government the largest employer of labor, at 70% of the workforce. So how do you move government-owned companies to private individuals who have the capacity to manage them thoroughly, like Britain did under Margaret Thatcher, and Germany also did under Helmut Kohl and Gerhard Schröder? How do you move it? The next step will be for them, like I said earlier, to come up with a good competitive advantage. What are we strong at that no other nation can do as well as we can do? And then they have to sell themselves. And they have to sell themselves. They have to boost confidence to the market and make the market believe that if we buy your government bond, you will not default on the payments like you did before.
Okay, do you believe in Greece? Do you have faith in Greece going forward, that the country will come out of this very, very dark, it's 50 year of recession for the country now? Do you have faith in Greece that going forward the country would, just bounce back? It's a beautiful country. They had a very vibrant tourism sector, beautiful beaches, very accommodating people. What do you see Greece, what does the future hold for Greece, especially in the medium to long term?
I believe Greece is still going to be in recession for like 30 to 5 years, if not on the upside 7 years. I think that things will begin to bounce back from the 8th year. I have a grim faith on Greece. I believe Greece has to stay in the monetary union. If it goes out of the European Union, it's finished. I think Greece has to stay in the monetary union, and the European leaders have to do all they can to keep Greece in.
Well, they have been doing all they can to keep Greece in.
If they don't, it will be disaster for them also.
I think from all that's happened so far, all the comments, all the steps, all the money that's been put on the table, I don't think a country like Germany and France will go through all the trouble they've gone through to ensure that Greece remains in the EU, putting that kind of amount of money. Angela Merkel risked being voted out by her own caucus
surprisingly
over Greece. So definitely
our approval rating has been increasing.
So I guess it's all that ends well. Ended well for Greece. Now we're almost out of time. Now, quickly, finally on China, we saw manufacturing recovering. The latest data we got about 2 days ago. The primary producers managers index. I think it
up to about 49%.
50.1. Well, we did have some. We had different reports. One from HSBC, one from the Chinese government itself, which had it at 50.1, but HSBC had it at 49.1 or something. But below 50 is a contraction, so that's negative on its own. But above 50, which is what we got from the Chinese government, was an expansion.
Yes, I have fears for China, and Esther, you agree with me that I've always talked about the fears than the faith I have in China. And the fears I have is that, we're talking last week that the level of economic development in China is way higher than the level of social and political development in China. That is a terrible risk for China. I also have fears that the level of imports that comes to China and the level of export that goes out of China, the level of imports will soon gradually start to catch up with exports, and the current account might start running into deficits. So I believe that on the long term, the Chinese government has a lot of structuring to do. It has a lot of regulatory fine point it needs to pay closer attention to, and so that growth in the private sector does not spiral out of control.
Okay, thank you so much, Kelvin.